Hey dividend investors, today I am going to be talking about a very interesting ETF. Well, really any covered call ETF is interesting to me because they usually have ridiculously high dividends, and this one is just that. It has a very high dividend. This today is ZWH. It's the BMO US High Dividend Covered Call ETF, and basically what this means is it's usually using a covered call strategy on the option side to get you yield, to get you a dividend, meanwhile holding basically a diverse level of stocks, of course, on the US market that pay a dividend itself, but also have high liquidity, high volume on the stock side, but also on the option side as well. What this does for you is it allows you to have underlying growth in your portfolio, but also allows you to really get a lot of dividends. And that's what we're going to talk about today. What does this ETF actually have? Is it any good? Basically, everything about it. Let's get down and let's check out ZWH today. So the portfolio strategy, I'll just read that really quickly. BMO US High Dividend Covered Call ETF has been designed to provide exposure to a dividend-focused portfolio while earning call option premiums. That right there is what's going to basically give you your dividend. It's a massive dividend. So I love it. I love this. So anyways, the underlying portfolio is yield weighted and broadly diversified across sectors. So you're not just going to be getting the banks. You're not just going to be getting just a single exposure to, let's say, rails or oil or gold or whatever. You're getting diversified. So it's going to be protecting you a little bit more. What a covered call strategy does for you is it basically allows you to not have such a huge downside when there's a little bit of turmoil in the markets. The downfall to a covered call strategy, however, is the fact that, of course, it is protecting you on the downside, but it's also stopping you from gaining massively on the upside. Whenever there's turmoil, this is kind of going to level you out, essentially. Now, the call options that they are doing are written out of the money and selected based on analyzing the option's implied volatility. Basically, what that means is you'll see in a lot of covered call strategy ETFs that the actual underlying asset tends to go down over time. And then what does that mean? Even though the stock market may be going up, you see a lot of covered call strategies going down. Why is that? Well, they don't use this strategy. This strategy will allow you to have the underlying asset continue to go up while still paying a very high dividend. So let's just check this out really quick. What is the dividend like today? Well, the dividend as of the 18th of December, which of course the stock market has gone slightly higher, but this ETF has slightly gone higher. I'm going to say it's roughly around 6.5 today. That's a pretty healthy dividend when you start looking at US exposure. A lot of US companies either dislike paying a dividend or dislike paying a high dividend because they think it takes away their ability to grow their business. Well, in my opinion, 6.5, 6.6 in that range percent is really good, very healthy. Next is the management fee. So the management expense ratio is 0.7%. How I like to look at that is, of course, the underlying asset has to go up at a minimum 0.7% every year for it to basically neutral out the management expense ratio. But how I personally look at it is it essentially takes away from my yield. That's how I personally like to look at it. So technically, you would be getting a 5.8-ish, 5.9-ish percent yield. Technically, if you in your mind take that and minus it from that. That's how I personally do it. Not everyone does it that way. It does pay monthly. So if you're looking at an ETF to pay you every single month, something that is going to allow you to have basically passive income in a sense, then these types of ETFs are going to be very helpful. So if you're retiring or if you're looking to have yourself a backup income in case your main source of income goes away, then this is a fantastic way to do it. Now, the market volume is not bad for an ETF. It's 33,000 shares roughly per day on average. So personally, I like that. Anything above 10 to 15,000 for an ETF is good. You want this number to be higher if you're looking to day trade it, or if you're looking to basically not be afraid of selling it, because let's say the volume is very low and everyone's selling that day, then you're not going to be able to get out of it as easily. But at 33,000, I think personally that's not bad. So at its lowest point today, if we went year to date, then its lowest point, if you had 10,000 invested, you would be down 30% year to date at the lowest number, or the lowest time, which was March 23rd. Of course, we had that massive COVID thing, which that word probably just made me demonetized, demonetized in the future if this channel ever becomes monetized. But either way, at this point in time, almost a whole year has gone by, then we would see that we're basically breaking even at this point, so not bad considering how bad of a year it was. This still paid a dividend over that time span though. If you put your money in way back at the beginning, way back in 2014, well, now it's almost 7 years later, and we are currently up at double. So unlike other covered call strategies, what usually go down over time, it's actually going up over time because of the way they structure their covered calls. So I love that. If this can continue to happen, of course, whatever happens in the past is no guarantee on what happens in the future. This is really telling me that it is a good investment, at least in my personal eyes. Make sure to obviously go out and get your own assessment done with your own registered trade stock person at your bank, whatever you want to call them, whatever the bank calls them. Every bank tends to call them something different. And of course, that we do see it is a very standard 11 cents just distribution every single month, 11 cents times however many shares you have. This is good. And also, this number has increased over the time that it has been around. So way back at the beginning, I think it was paying around 8 cents per share. Now it's paying 11 cents per share, which is absolutely fantastic. So some of the bigger names that they are holding that I like is Bank of America, fantastic. Apple, that's going to keep on skyrocketing. JP Morgan, any bank. I love banks. They make money, they print money. Basically, they are money. And Microsoft, I'm more of an Apple guy. Personally, I don't use anything Microsoft other than the sync in my car. But again, not a bad company. Coca-Cola is one of those companies that Buffett owns. Anything Buffett owns is golden. Home Depot is just absolutely amazing, especially when we start having life after COVID. People are going to be continuing to build houses, continuing to do upgrades, so they are going to be a winner. All of these are winners. And of course, they are the biggest holdings in this ETF. Now, if you're somebody who's just getting out of mutual funds, like I've got quite a few family members who are leaving mutual funds going into ETFs because they have a lower MER rating, a lower cost to own. This is MER if you didn't already know. And if you are in a medium risk mutual fund, then this is an ETF that could get you a little bit more return on your money. I hope that this video has helped you understand this ETF. If it has, hit that like button and subscribe, and I'll see you guys and girls again in our next video.